Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's chief equity strategist, John Blank, to talk about what's happening in the economy and with the summer stock rally. Should you take profits here? It's looking a little shaky to me. You might want to, but we're going to talk about it. So let's start with the economy, John. We've had 2 quarters of declining GDP. I think the last time you were on the podcast when we talked about the recession question, we were talking about the GDP, how it wasn't the final deciding factor about the recession. We did get another decline. Most people are saying we're not in it. The job market's holding up well. I've been looking at the Challenger Grain Christmas data because a lot of people on Twitter and social media keep telling me, but Tracy, there's these layoffs happening, almost every day. And we are getting some more layoff announcements, it seems like right now. But if you actually look at the Challenger Grain Christmas data, we're actually well below last year on the actual announcements. So they don't cover, who's claiming unemployment and all that stuff. But I took a look at the data and they have through July, 159,000 jobs were cut this year. Now that's down 31% from last year, where through July 2021, it was 231,000. And then this year, through January through July, that total time period is the lowest number of job cut announcements since 1993, which is when Challenger Grain Christmas first started tracking these announcements. And then interestingly, everybody thinks, tech, it's all happening in tech, but it was actually auto that is now leading in the number of job cut announcements. It was 25,000 through July, with about 9,500 in July. And then we just heard from Ford that they just announced another 3,000 here in August. And then number 2 category wasn't even technology. It was financial firms. They've made announcements of about 12,900 or so far this year. And most of those are in the title area, mortgages, things having to do with real estate, where it's slowed dramatically and mortgage brokers are being laid off. So, John, when you look at data like this, what should I be taking away from what's going on in the economy right now? As an investor and someone, who is concerned about the job market maybe, and just the economy in general.
Yeah, so let's take these last 2 in turn here, and I'll get your answer to my question. So Ford eliminated some jobs. What does that tell you about Ford, good or bad?
Well, I don't know in this type of market conditions, because I know that there's still the chip issue and these other things going on. I know that there's shutdowns in some factories, overseas, that might be impacting how many cars they can build in the US. So I don't know. It's maybe telling me that they still have supply chain issues.
Right. So what you're learning here is Ford's going to put the F-150 Lightning out, and they're putting a ton of pressure on themselves to raise the profit margin on that vehicle at a time when their cost of production of that vehicle is going up because of the supply chain issues, right?
Yeah. Mm-hmm.
So that's a good example where you're seeing them make a tough business decision to improve a business model, but it's actually bullish because if the F-150 works and is profitable, and that's the big key for these electric vehicles, is they're profitable, then Ford itself will massively grow in the years ahead. So again, that's a story of a structural change, right? Structural change.
Right.
And, it has a relationship to the policy effects of the COVID pandemic, as you brought to the table. But it also has longer term effects of climate change and, the gas story. So there's a number of ways to to bring yourself around to understanding that the forward numbers and basically writ large, all the vehicle production numbers are telling you a story that's inconclusive about the economy, right? It's not a summary statistic. It's a sector. It's a big sector, but it's a sector. So we've tried to make this point to a lot of people, but summary statistics of the economy are relevant for the economy. And if it's not at the economy level and a summary statistic of it, then it really doesn't not matter, but it doesn't matter for the purposes of diagnosing a recession. Now, the second one you brought up, which was the title companies and the banks cutting back.
Yeah.
Why is this happening, Tracy?
Well, the housing market is taking a tumble.
Right, because the Federal
because
Reserve
the rise in mortgage rates.
Right. So the Federal Reserve System, as we all know, will have the Fed funds rate at 3.5 or 3.75 here by the end of the year. And you put that into the 10-year Treasury context, it's about 3. You tack on 2.5 to the 10-year Treasury, you get a mortgage rate of 5.5, probably by the end of the year 6. And that tanks anybody who's trying to put up a mortgage lien on a house, and that tanks the mortgage people who issue those liens. So again, is that a good story? Obviously, this is part of the slowdown that the Fed is trying to engineer. It will be reflected, again, just like the auto thing, at the highest level. But again, it is not a summary statistic. It is a subgroup of businesses that are being influenced negatively at this point in time. And we just have to watch out to see how or whether, even if it spreads further, it's pre-planned, it's pre-packaged, and it's actually wanted by the Federal Reserve System. So again, to get everybody back to where we always end up, and it's to the summary statistics, so I will read you the July employment situation summary for the total non-farm payroll. Just to put this in context, I'm just reading this verbatim from July, the first Friday of the month. In August, it came out 2 weeks ago. Total non-farm payroll employment rose by 525,000 in July, and the unemployment rate edged down to 3.5%. The U.S. Bureau of Labor Statistics reported today job growth was widespread. Let me repeat that. Job growth was widespread, led by gains in leisure and hospitality, professional business services, and healthcare, which, of course, none of those are what we've been talking about. Both total non-farm payroll employment and the employment rates have returned to their pre-February 2020 levels, pre-pandemic. Now, if we go all the way to the bottom, we also tell people to do this. We want to look for the revisions to the last few months, because obviously these numbers come out the first week of any month. And they actually, you got to remember, the Federal Reserve, the Bureau of Labor Statistics, trying their best to get the data out as soon as possible. But if you ask for them to do it in 3 or 4 days after a month rolls over, they're going to have some lags in quality of the data. They fixed this. So this is the real story that we really need to care about. It's the very last paragraph. It says the change in total non-farm payroll for May was revised up by 2,000 to 386,000. And the change for due was revised up by 26,000 to 398,000. So you have May at 386,000, you have June at 398,000, and you have July at a preliminary 528,000 job additions. So Tracy, having said that to you, are we in a recession?
No.
No. The answer is no. Yeah. I want everybody to understand, when they're going out to tee off with their friends, this is how you answer the question, and it's not a debate. Tracy and I are not going to debate this today. We are not in a recession, period. There is not even a discussion of this matter. What's only going to be discussion is how often Tracy and I look at this monthly non-farm payroll data until we see something in that summary statistic that concerns us. But Tracy's only answer that I would have accepted today, and Tracy wasn't going to give me any other than no, we're not in a recession, period. So that brings us to the final point of any of these discussions. Why on earth are we having to discuss a country's economy that's actually quite strong with a 3.5% unemployment rate as though there's a recession going on? That's the real question, Tracy. And why do you think that is?
I don't know. Everybody is just thinking the doom and gloom, because every time the Fed has raised in the past, it has pushed us into a recession for the most part.
Right.
So everybody's anticipating one to come.
Right. I'm glad you said that, because I just, last there's a friend of mine who I was walking down this beach in Santa Barbara last weekend, and we set an hour long for him to finally come to realize there's two different questions that are getting people confused by. Are we in a recession is a factual statement at the moment. The answer is no. What has been gotten in front of everybody is, will we go into a recession because of what the Fed's doing? That is unfortunately not answerable because it's out in the future, right?
Right.
And the problem everybody loves to do, since markets, financial markets in particular, stock markets are probably the most looking ahead 12, 16 months. They've already discounted this information for you. So the question is, does the stock market's decline and the Federal Reserve's interest rate hikes bring about a soft landing or not? And that answer is somewhere 12 to 16 months from now. So the discussion most people are having has actually been priced in by these financial markets. And the answer is inconclusive, and it's somewhere out at the end of next year that this market's looking at. Not even, this is the other thing that's fascinating about these discussions, is when you say when in the future, every time you deal with this, it's been a few more months, it's been a few more weeks, and you're moving, and the markets keep on looking further and further ahead. Right now, if you're thinking about financial markets, stocks, everything, this market's pricing in what's going to happen at the end of 2023, early 2024 now.
That's a long way away.
It is. And I think most people don't realize, just like, you're sitting in a market that's priced in something that's a year and a half out. And that's why people can get more bullish than you'd think, because it's entirely possible that we have a decline in, some type of macroeconomic variable in the first half of next year. And, this market's already looked beyond it.
Okay. So what do you make of the summer rally that we've had then? That is the part that the market's looking beyond?
Well, first of all, the market doesn't have to be pricing in the macroeconomic situation. That the biggest problem right now is people are thinking that, it's a soft landing, or no, it's a soft landing. The stock market is only concerned about that. That's not true. The market in the stock market context can price, particularly today, just basically on the 10-year treasury rate. And if the 10-year treasury rate goes up for whatever reason, then the stock market will go down. And so, and that can happen right now, and it can happen in the next few months. So we can have a tanking stock market here the next 4 months if the 10-year treasury goes to 4%. We will have a tanking stock market, right?
Yeah.
And that has nothing to do with the economy again. That will certainly take down those bank title jobs you already talked about. It will probably put some pressure on, auto finance and other areas. And it will certainly cut down on the wealth of people's 401ks. But that has to do, again, we would then at, end of the year, if that indeed did happen, then we would look to the non-farm payrolls then to see if we could net out what really at the aggregate macro level happened to the economy from this. But the point is, we can have a tanking stock market because the Fed's raising rates so rapidly in the next 4 months, and that does not mean we're going to go into recession. It might be a recession. I'm not saying it won't be a recession, but I'm saying it is just financial market related, and financial markets do disentangle themselves from the economy, and they do care a lot about the 10-year right now. We know this, and that's really what's driving stocks. And so, we get a 10-year treasury at 4%, forget your stocks are going down.
What do you think about some of the manufacturing data that we're getting? We've had like a big slide in Empire Manufacturing. Chicago PMI went negative last month for the first time since 2020. And people are starting to look at that manufacturing data again. Is this just kind of a fake out like we saw in 2015, 2016, when all the manufacturing data went negative? There was a manufacturing recession that went on, but it never spread to the overall economy. Is that a possibility on the manufacturing side?
Well, I think, we got to understand that it took, 16, 18 months, maybe 24 months of COVID pandemic shutdowns, and that there was a process that went through those 24 months. And now we're having a kind of a mirror process. I don't know, mirror is maybe not the right word, but a process of another 18 to 24 months. It's unwinding that repression. So the first thing that's going down here is the manufacturing, because it went up first. Right, and then you got inventories built back up within the manufacturing, not within their customers, but within the manufacturers themselves.
Yeah.
And that's the first stage in lower port costs, lower port shipping, and lower prices, which so it's actually, again, part of a slowdown. But again, the services and the consumption rates are 75% of the economy. This is just the more volatile, more immediate thing. And it's also very linked to this COVID pandemic play out, which is unique in the last 100 years. And it has to be reminded that, again, we have to understand that this is sort of what one could interpret happening after you shut manufacturers down for so long. If they'll ramp up and then they'll slow down again.
That makes sense. I think people read a little too much into the manufacturing as for the overall economy, at least.
Right. It's the same problem we talked about over and over again, which is people read and then they think that's going to be this economy-wide thing. And the economy is the aircraft carrier. And you may not, on the fifth floor of the aircraft carrier, the food may be lousy in the cafeteria and everybody may be sick. But there's, the aircraft carrier is going to still carry on.
Right.
And that's what really struggles with most people and why we try to get people back to summary statistics that are current, not trying to look too far into the future because you can't see any better. It's already priced in, and not taking so many of these sector stories, dramas, as some kind of clean play and understanding of the macroeconomy. They really aren't, because you're only looking at one little thing. So everybody's getting sick in the fifth floor of the aircraft carrier because the food stinks, but the aircraft carrier has 30,000 people, and those guys don't even matter, and nobody cares.
It reminds me a little bit of what is happening in retail. It's so diverse, the stories within retail right now. Even along of grocery is doing XYZ, but apparel stinks, or beauty is soaring, but handbags are on the down. It's so unique to each individual and even the type of customer that they have, that we're not really getting an overall idea from the retailers like we thought we would. We thought it would be just the retailers, and it was this one sector that was going to tell us what the consumer was doing. But now it turns out that that's not possible, because different consumers are behaving differently under these inflationary conditions. And, it's not a one story thing with that entire sector anymore.
Totally agree with that statement you just made. And but just remind yourself how carefully more nuanced your language was when you described it.
Oh, for sure.
Yeah. I mean, the other thing I tell people to watch out for is, these discussions, if they aren't referencing actual current material in a verbatim way, and people are not using specific and careful language, they're just talking their book.
Yeah, for sure.
Because like you've said, there actually is no discussion today, and I mean this. I'm not trying to be a jerk, right or left. There is no recession, period, at all in the United States right now. Period. There's no discussion.
And I think that's why people are a little shocked when we got that 528,000 job number, because they were in their minds saying we're in a recession, and then that number came out, and it doesn't jive. So they were shocked by it.
Yeah, and I'm like everybody else who lost, a couple 100,000 in my 401ks from the stock market collapse. But since I am an economist, I understand that's done because the Fed did it. And, this is not to be interpreted. So just for example, when an economist sees something like that happen to their portfolio in their retirement, the typical multiplier is 1 to 20. 1 to 20. So only 5% of what happened to me is going to be affected in my income. So if I lost 200,000, that means $10,000 hit on my income this year relative to everything else I'm making, right?
Okay. Yeah.
So what does that mean? Basically, I ignored it. I'm not thrilled with it, but it's not killing me either. And it certainly didn't change any of my current income patterns whatsoever, right?
Yeah.
But the pessimism will be reflected in the Michigan consumer sentiment indicators because of the stock market collapse. Consumer sentiment indicators always track stock markets. And you're always also going to feel if you're a lower income person, which you brought to the table, you're going to feel shocked at the kind of prices you're paying for standard goods in supermarkets and, hardware stores and whatnot. That it will be a real issue for, and it will also be picked up by consumer sentiment indicators. So that's not to say just because the economy is not in a stressful situation overall, that great swaths of it are in stressful situations, because they are.
Right. Oh, for sure. Yeah.
And that again, this gets into the discussion we are having and need to have, which is, just because I'm blessing the idea there's no recession doesn't mean I bless the idea there's no stress.
Correct. Yes. Two different things. Okay, so let's switch gears a little bit and just talk real quick about this summer rally. We've seen some big gains in certain types of stocks. A lot of the beaten down stocks, some of the FANG names are up big, or FANG man names, I should say. So Apple's up 22% in the last 3 months. Netflix is up 21%. Microsoft up almost 10% in there. And then speaking of retail, numerous of the retailers up really big in the last 3 months. So CROX, I tracked that one. It's up 38%. Deckers is up 29%. One that you owned in one of your portfolios that I saw you're selling out, Williams and Sonoma, up 52% over the last 3 months. Dick's Sporting Goods up 45.8%, and they just reported earnings and raised guidance. So there are some good things going on. I know CROX had a strong report. Deckers did. We're still waiting when we record this on August 23rd. Williams and Sonoma is about to report earnings, but that should still probably be pretty solid too. So should I be selling here? You're selling some of yours, I see. Should I be getting out on this kind of big rally in some of these names? I mean, it's big.
Yeah, well, as you know, I took profits on Dick's and at WSM for my portfolio for actually they're up 60% in 3 months, right?
Right.
So that is just typical trading. I'm trading it. I'm just saying, look, I'm selling the news on everything being fine, because I told you several months ago when we did this that was fine, and I bought those stocks then, right?
Yeah.
And now I'm just getting out of them because everybody's going to overinterpret this. I'm just going to make money for people.
Okay. Yeah. Well, that's the short-term trade, right?
That's the short-term trade. Doing, right? This is the other thing people got to understand. Guys, if you're looking ahead, then I'll just say, sure, Dick's had a good report. I told you that was happening. I'm not worried about Dick's. I wasn't worried about Williams Sonoma. I'm still not. I'm just getting out of the trade on the news. I'm also getting out of the trade because I think that the fair value of the S&P 500 is somewhat around where it is now, and the shorts are going to pile on these stocks, and I just want to close out 60% gains in 3 months for my traders.
So, but you're basically saying you don't really believe that this rally is going to hold either.
No, because I think ultimately I cannot countenance. I think we're in a kind of interregnum in August because the Federal Reserve is going to meet in September and November, the rest of this year. So we've been giving a blessed without having actual rate hikes, not discussions of them, but actual ones. And when those actual rate hikes hit in September and November, and we're going to get another 100 basis points out of those two meetings, then the Fed funds rate goes to 3.5 for sure.
Yeah.
If not 3.75. And I do not see the 10-year staying at 3.0 like it is today when that happens.
No, me neither.
Right. So then I again, I'm not saying a macroeconomic thing. I'm just saying the Federal Reserve System is going to crank 100 basis points on the Fed funds. It will 1-for-1 at least be reflected in the 10-year, and that will tank stocks from here for sure.
Yeah. On the short term. So
it's just against the difference. Another thing people need to understand is financial markets and stock markets, and the economy are two different subjects. They actually have their own stories too.
Okay.
So I am bearish on stocks for the next 3 months.
Okay.
But I'm not actually thinking yet the economy will tank, because I think it's still to be determined that the interest rate sensitive elements of the economy are going to roll over the rest of it, because I think there's other dynamics playing out that we've already discussed.
Now, do you think you should just stay on the sidelines then? Like if you do sell some of these winners, should you just stay in cash, kind of see what happens? I know, the sentiment out there is keep some cash because it's going to going to decline again, and then, buy then.
Yeah, I'm with that sentiment. I mean, I think you got to play
Okay.
both sides. I've done this for the last few months. Have some
Yeah.
stuff because they're going to get these rallies, and then you just want to be in some stocks. But you also want to make sure that you don't panic. Make sure your cash is much higher than normal, because you're going to get a chance, not a perfect chance. Unfortunately, people think it's a perfect chance. That's not the case.
Yeah.
But because the market looks forward 12 months, and it may just decide to ignore everything the Fed does. Nobody really knows that's going to happen. But, in general, you should be ready for, better prices than now. I mean, again, right now, we got to remind ourselves that there's always two sides to buying and selling stocks, and markets look far ahead, and it's entirely possible that we can get 100 basis points out of the Fed in September, November, and the stocks rally because they look beyond it.
Yeah, for sure. I could definitely see that.
In advance of this reporting, would I bet against that? No, because I think it's material and it really will head. I just have a trouble believing it won't. But there is an argument, and a strong one, that they will, right?
Yeah. Mm-hmm.
Because the real question then remains, well, what does the Fed do after these rate hikes? And this is, as I spoke to some other people about, it's really tough because it really becomes a question of how long do they stay at that level? Do they stay at 3.75 for all of 2023, or do they move it around? So my first answer is they'll probably stay at 3.75 or so as a pause for 6 months.
Okay.
And then we'll see. And they will see. And they will be data dependent. And in 6 months, which will be, May, April, June of 2023, they're going to have to face down what to do from there with their rate structure. And that will be determined by the price levels that are showing at that time. And, we'll find out.
More dilemmas to come.
Yeah, the other thing we need to point out for people, the Federal Reserve System meets 8 times a year. It's not bogus. They really do meet. They bring data to the table. They run their models 8 times, if not more. And it's done in 13 or 12 different groups, including New York and Washington Fed and all the regional areas, plus private people. And they just keep updating. And that there is, in this fluid environment, more data dependence than less data dependence. They really, really will pay attention.
Is there any sector you're particularly watching to buy on the next dip?
Yeah, I think, you've got to like the mid caps, and you've got to like, I think the industrials, because, you got a nice play for the material stocks coming down. And I think you've got a decent place for them to start benefiting from it. And they're kind of the hidden story. But that's all I really have. I don't think there's a lot going on because I think most of everything will be, kind of compressed. I mean, one of the concerning things you get out there, I was just reading about OPEC monthly August report, and the number of regions of the world economy that are 1% growth rates is pretty dramatic. Europe is somewhere 1% growth rate. Brazil is at a 1% growth rate. Japan is at a 1% growth rate. Not surprising, but it is not strong there. And then you have China, which is actually not in good shape either. So, and then the United States is probably going to book a 1% growth rate. So, it's kind of concerning to see so much of the world economy at a 1% growth rate. But then the flip side of it is, well, it's certainly not putting too much pressure on all these prices anymore, right?
Right.
So in some respects, I mean, everybody's thrown a Fed Chair Powell under the bus because he came late to the rate hiking thing, but he got a lot of benefits out of the Ukrainian thing and the COVID pandemic policies of China and a lot of other things that played out in tightened for him anyways, right?
Yeah.
They're just not in the United States.
Okay. Well, we covered a lot on this episode. It's always interesting. Thanks for coming on, John, because this is a tricky time. It has been all year for investors, trying to figure out the Fed and the economy and what's going on out there. So I'm sure, we'll be talking again in the next couple of months as we get closer to the end of the year to see what's developing here. And in the meantime, let me recap the stocks we talked about on this episode. So we talked about numerous of the retailers. They've had a big rally here, but they are reporting some solid earnings reports and even outlook into the holiday season now, which is fast approaching. I know it's hard to believe, but it is. And those were Williams & Sonoma, ticker WSM, Deckers, that's the UGG shoes, Deckers, DECK, CROX, also in the shoe area, CROX, Dick's Sporting Goods, DKS. Then we talked about a couple of the FANG men stocks, Microsoft, MSFT, Apple, AAPL, and Netflix, all rallying NFLX. And as always, be sure to subscribe so you don't miss a single episode of The Market Edge. You can get us on SoundCloud. We're on Apple Podcasts, Spotify, Amazon Music, and just about anywhere you can get the podcasts. But be sure to get us, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.